Hello guys, today we are going through economics for accountants. Roman 1, accountancy. In general terms, accounting consists of procedures for recording, classifying and interpreting selected experiences of an enterprise to promote effective administration. More especially the accounting function can and often is broken down into specialization. A common distinction being made between management accounting and financial accounting. Management accounting is to provide management with the best possible information upon which decision can be based and enable both effective use of an organization's resources. The older specialization of cost accounting is perhaps the best considered as part of management accounting, which establishes budgets, standard costs and actual cost of operation and processes. Financial accounting, by contrast, is concerned with the analysis, classification and recording of financial transactions in order to illustrate the effect on the performance and financial position of an undertaking. Both aspects of the accounting function must be executed if the organization is to have adequate information for its management, to formulate policy, and to plan and control operations. The role of economic knowledge. In no type of organization can the accountant operate in isolation. However, he or she must have a working knowledge of many other areas which impinge on the business undertaking. The most relevant field of knowledge are considered to be law, management, statistics, behavioral studies, information technology, and economics. The accountant is not expected to be an expert in these subject areas, but to have sufficient knowledge to relate intelligently with specialists in such areas, and to know enough to appreciate when and where to go for this specialist knowledge. As part of the management team or advisor to that team, the accountant needs to appreciate the opportunities and constraints which the economic environment offers or impose on the organization. As part of the given that allocation of resources is a central concern of economics, the relevance of economics for the accountant follows. The accountant as a key provider of financial information for planning, control and decision-making purposes will be better equipped to provide relevant information if he or she is aware of the organizational objective and the environmental constraint within which these objectives are pursued. As a final word, one can also say that accountants need economics to understand, analyze and solve economic problems of the organization and society in general. There are a couple of questions which we will skip now. Then we head to chapter 2, demand, supply and determination of equilibrium. Demand analysis. Introduction. In any economy there are millions of individuals and institutions, and to reduce things to a manageable proportion they are consolidated into three important groups, namely household, farms, central authorities. These are the dramatis personae of the economic theory, and the stage on which much of their play is acted is called the market. Household. This refers to all the people who live under one roof and who make or are subject to others making for them joint financial decisions. The household decisions are assumed to be consistent, aimed at maximizing utility, and they are the principal owners of the factors of production. In return for the factors or services of production supplied, they get or receive the income, e.g. labor, which is wages and salaries, capital is interest, land is rent, enterprise is profit. The farm. The farm is the unit that uses factors of production to produce commodities Then it sells either to other firms, to household, or to central authorities. The firm is thus the unit that makes the decision regarding the employment of the factors of production, and the output of commodities. They are assumed to be among of um, uh, they are assumed to be aiming at maximizing profits. Central authorities, these are comprehensive term, include all the public agencies, government bodies, and other organizations belonging to or under the direct control of the government. They exist at the center of legal and political power and exert some control over individual decision and over markets. Demand analysis. Definition. Demand is the quantity per unit of time which consumers are willing and able to buy in the market at alternative prices, other things held constant. There is individual versus market demand. Individual and market demand schedule the plan of the possible quantity that will be demanded at different prices by an individual is called individual demand schedule. The plan of the possible quantities that will be demanded at different prices by an individual is called individual demand schedule. Such a demand schedule is purely hypothetical, but it serves to illustrate the first law of demand and supply, that more of a commodity will be bought at a lower than a higher price. There is a table there. We have price in shillings. We have 2 columns and how many rows? 9 rows. We have price and the on one column, and we have quantity demanded per week on the other column. In the first row we have 20, the quantity for the 20 shillings, 3 quantity demanded per week. 18 shillings, 3.5 quantity demanded per week. At 16 shillings there is 4 quantity demanded per week. At 14 shillings there is 5 quantity demanded per week. At 13 shillings there is 6 quantity demanded per week. At 12 shillings there is 7 quantity demanded per week. At 11 shillings there is 8 quantity demanded per week. At 10 shillings there is 9 quantity demanded per week. That is the table of the individual demand schedule. Theoretically, the demand schedule of all consumer of a given commodity can be combined to form a composite demand schedule, representing the total demand for that commodity at various prices. This is called the market demand schedule. Represent the total demand for the commodity at various prices is called the market demand schedule. We have a table of the market demand schedule. We have 2 columns. The first column we have price in shillings, and the second is quantity demanded per week. At 20 shillings, 100,000 quantity was demanded that week. At 18 shillings it increased to 120,000 quantity demanded. At 16 shillings 135,000 was demanded. At 14 shillings it increased to 150,000. At 13 shillings it increased to 165,000. At 12 shillings it increased to 180,000. At 11 shillings it increased to 200,000. At 10 shillings it increased to 240,000. At 9 shillings it increased to 300,000. At 8 shillings it increased to 350,000 Kenya shillings. 350,000 quantity demanded per week. These prices are called demand prices. Thus, the demand price for 200,000 units per week is Kenya shillings 11 per unit. The second Roman we are going to draw in the individual and market demand curves. The quantities and prices in the demand schedule can be plotted on a graph. Such a graph after the individual demand schedule is called the individual demand curve and is downward sloping. An individual demand curve is the graph relating prices to quantities demanded at those prices by an individual consumer of a given commodity. Here we have a table there. We have price and we have quantity on the horizontal axis, and on the y-axis, the vertical, we have the price. We have P1 and P2. When the price is high, the quantity is low, and when P2, the price is low, the P1 to P2, then the quantity increase to Q1 to Q2. Now the demand therefore is the demand increase. The curve can also be drawn for the entire market demand and is called a market demand. And we have curve. A market demand curve is the horizontal summation of the individual demand curves by taking sum, i.e. by taking sum of the quantities consumed by individual consumer at each price. Consider a market of 2 consumers. At price P1 in the figure above, consumer 1 demand quantity 1, consumer 2 demand quantity 2, and the total market demand at that price is quantity 1 plus quantity 2. At price P2, consumer 1 demands quantity 1 and consumer 2 demand quantity 2, and total demand at that price is quantity 1 plus quantity 2. Therefore, DD is the total market demand curve. Factors influencing demand. And we leave it there for today. Kindly subscribe, like and comment and share.